Raised market capitalization worth nearly 15 lakh crore rupees today.
The rupee sees its biggest fall in nearly 2 years, sliding nearly 0.5% against the dollar after the dollar index surges past the 109.8 mark. Higher crude prices also weigh on currency. Call rate and bond yields spike as bankers say repo rate cut in February looks unlikely and instead could see another CRR cut.
Oil flares up after US imposes sanctions on Russian oil producers, oil shipping companies and insurers. Wider US sanctions expected to affect Russia exports to China as well as India.
Hello and welcome to a fresh edition of Markets Forward, your go-to show where we get you up to date with regard to today's trading action, which was rather weak, and we'll set you up for tomorrow. I'm Nigel, and with me is Surbhi. Well, Surbhi, at 3:30, the bulls were breathing a sigh of relief.
That the market finally closed.
Yeah.
Nigel was in the pink of health, but not quite for the market today. None of our pinks and lilacs, none of the colors really showed up because the only color on the street was red. And more red. So just a bit of a global context to this before we talk about really what transpired. It is that non-farm payrolls report, and that's where the problem originated right from Friday. That number was so hot, the non-farm payrolls addition was so much more than anticipated. 256,000 jobs getting added in December in the US, whereas the expectation was just 155,000. And that led to a massive move on the dollar, on yields, and of course on equities as well. And Nigel will talk more about the move on yields and the dollar. But what transpired was market pricing in fewer and fewer rate cuts from the Fed in this year. In fact, if you're looking at the Fed Watch, the CME Fed Watch tool, then the probability of no rate cut is as high as 97% in January when the Fed meets in January. It's as high as almost 82% for the next policy meeting, which comes in March. And even in May of this year, the probability of no rate cut is as much as 72%. And all of these numbers changed after that jobs report got in. So the equity market had to price it in, the currency market and the bond markets had to price it in. And we saw the impact playing out for us here as well. And the net result on the Nifty or on the broader market was very, very severe. It was a trending down day. There was a lot of momentum on the way down. And let me just put the heat map, up for you on the screen, whether you're looking at the Nifty and the stocks on the Nifty, or whether you're looking at even individual sectors and indices. Nothing mattered today. It was all red, one of those big wide days, Nigel, where it was literally all fall down, no place to hide.
Well, the bears were on top in today's trading session. And we're looking at the global cues that we're talking about, Surbhi. Normally we track three indicators. One is the dollar index, the 10-year yield, and Brent crude prices. And you said one of them could give comfort. No, that wasn't the case. Brent crude prices were higher. The dollar index as well was at around 110, and the yields, in fact, they scooted off to 4.7%. So the global cues itself were rather weak. The key indices in today's trading session, the Nifty was down. The Nifty Bank has been the big underperformer. That continues to drag. But the real pain and the reason that your portfolio is looking so weak is because what we saw in the mid and the small caps. Persistent selling out there, both those two indices ending at the low point of the day. And that's just the headline index, which was down 4% or thereabouts. Individual stocks were down anything between 10 to around 12%. So that's why portfolio is not feeling too good.
Absolutely. In fact, if we can, we should get those, those heat images up on the screen just to give you a sense of what went on, and also the advanced decline ratio, because there were over 2,200 stocks declining. Yeah, that's the heat map. Look at this. Every single sector down. It was only the IT index that was trying very hard to show some green, but look at it. There was no place to hide in the market today. And if you look at the advanced decline ratio, it's been a weak story for a long time. It's not just today, but today, these lines were never crossing. There was absolutely no hope. By the way, the mid-cap index has now cooled off close to 9% in the month of January itself. So it's been a very painful start to the year. Well, lots to cover. We'll, of course, go into a lot of these individual reasons, the currency, the move that played out on commodities, on why oil surged 5%, and, of course, the individual stock level action as well. But before we get to any of that, let's straight away figure out what the movers and shakers looked like, how deep was the pain in the large cap arena and in the mid caps as well. Those are some of the examples on your screen. We'll talk more about these stocks as we go forward. They were down quite a bit, particularly oil refiners, HPCL, BPCL, IOCL, all down. There were some very negative result reactions as well playing out. So we'll discuss these stocks and, of course, the key movers and shakers. Let's straight away go across to Hormuz for a blow-by-blow account of what transpired today. Hormuz.
It's difficult to find green when everything around you is red, and this was the kind of day that we had, particularly in the broader markets. The real estate space, I would like to highlight that in particular because the realty index has now gone into a bear market territory, and that means it has corrected 20% from the peak that it had made in June of last year. All constituents ending lower, losses anywhere from 6% to 10%. There was not a single stock that has outperformed in today's trading session. Some of the others that did not do well in today's session are down 10% or more, up to 10% as well. RVNL has almost halved from its peak. Adani Wilmar, PCBL, Just Dial, the other two being earnings reactions, also down anywhere between 10 to 13% in today's session. Oil prices, the rise in oil prices having an impact today. The OMCs were taken to the cleaners, anywhere between 4.5 to 6.5. ONGC, for which it is a relatively positive news considering the rise in crude prices, that too bore the brunt of a negative market sentiment, ending at the lowest point of the day. And Asian Paints, of course, being crude sensitive as well, ending 3% lower. Stocks that were volume-led losers in today's session: PB Fintech, after that downgrade from Morgan Stanley, 9% lower today. CESC came out with numbers on Friday extending losses, but CG Power, Indigo as well, under the crude sensitive, 5.5% lower. And lastly, there was some green that was on the screen, and it was Piramal Pharma that was among the gainers in today's trading session, 5% higher there. Some of the others, including the likes of CRISIL, AstraZeneca, and Aditya Birla Capital.
Okay, all right, Hormuz, thanks a lot for that. Well, let's go across to our guests. We have Anand, Tandon, as well as Jay Thakkar, who join us on the show. Hi, gentlemen. Thanks a lot for joining in. Jay, you go first. Where does the Nifty find support on a day-to-day basis? It's just been sliding low.
Good afternoon to you, Nigel. Well, see, Nigel, Nifty today has broken the very crucial support level of November, and that clearly indicates that now on a positional basis it has confirmed the downtrend. Already the momentum had gone into the sell mode. We had seen the Bank Nifty underperforming. That was a clear indication that probably Nifty would also provide a breakdown, which it has. In fact, it managed to do hold on till quite a few days because of Nifty IT, Nifty FMCG, the bounce coming out there. Else Nifty has now finally provided that confirmation, which clearly indicates that the falling channel target on Nifty comes to around 22,500 at least for this series. So Jan series talking about that 22,500 is a level to watch out for. And on the upside, Nigel, I believe that now 23,300 to 500 range will act as a very crucial supply zone. Until those levels aren't taken off, the overall trend will be negative. Interestingly, I would say, Nigel, that what has happened is if you look at the chart of Nifty 100, Nifty 200, 500, or even for that matter, Nifty, all of these, they are very close to providing a death crossover wherein, the 50 daily moving average, crosses the 200 daily moving average from the upside. And it's very close to that. We have already seen the private sector banks, the oil and gas sector, the realty pack, which, Hormaz was just talking about. It's already into the bear market, the infra space. They're already into the bear market zone because they all have provided a death crossover, and the auto index too has provided that. It's just that the Nifty 100 to 500, these are likely to provide it now. And if Nifty falls until 22,500, I fear that we would see that kind of a death crossover coming in Nifty as well, and which would further create that kind of a pressure going forward.
Right, Jay, we'll come back with more stock-specific advice in just a bit to you. But let's look at the other markets where there was plenty of mayhem playing out. I'm talking about currencies as well as bonds, because the Indian rupee continued to tumble to fresh lows today. Bond yields were spiking here for us in India as well. We have Lata joining in with the latest. Lata, what have you made of the day's events?
Well, first, the records. It's a 0.7% fall in the rupee, the sharpest fall in 2 years, intraday fall. And it's also one of the rare days when the rupee is an underperformer in Asian markets. Baht, peso, ringgit fell between 0.3 and 0.6, so less than the rupee. Yuan actually held steady, inched up a bit. Now, of course, everybody was falling because the dollar was rising. The dollar index was up about 0.43 on Friday itself. So you had to adjust to that. And in pre-market, numbers, it's not showing any signs of relenting. What did the Reserve Bank do? That was the surprise, because it was the Reserve Bank which made the rupee a relative outperformer. It was apparently supplying dollars, but it was not trying to protect any level. It was just trying to smooth, any very volatile moves in the market. The expectation, therefore, is that it was not just stock market, custodial bank buying, as you call it, by foreigners who are selling equity shares, buying dollars and moving out, it appears that those who were short on the rupee or long on the dollar were continuing to do that. So there is a lot of speculative dollar buying or rupee selling as well. The market is just not willing to give a near-term number because anything they say got taken. We started at 86.25, first 86, 86.25, 86.30, 86.50, everything got taken. The new level is 86.60 to 65, but the way in which US yields and the dollar index are surging as we speak, it's difficult to expect that there will be any level. Standard Chartered, whom we spoke to, said that the year-end level is 87.75, which is almost 88. But these levels don't make any sense. The fact that the rupee closed at the lowest point of the day indicates that clearly the selling pressure on the rupee or dollar buying craze is by no means over. The Reserve Bank, of course, can still surprise and hold, kind of trap the shorts. But barring that, no fundamental reason to expect that the rupee may stabilize anytime soon. On the bond markets, the 10-year yield jumped by 4 basis points to 6.84, but the bigger jump was in the call market. The call market is an intraday market where banks borrow from one another for 1 day. Now, it went to 7%. The RBI's mandate is to keep it at 6.5%. That's what is called the repo rate. So the RBI did supply money, but that was an indication that there is so much tightness because the Reserve Bank is selling dollars and that is absorbing rupee liquidity. Will the yield stop here? Well, it doesn't look like that because the US 10-year, as we all know, has jumped to 4.76 and today as we speak, 4.8 is almost being hit. So unless there is some stability over there, we shouldn't expect yields to stabilize over here. Bank of America, for one, has said that it no longer expects any cuts from the Fed in 2025, and something similar is being playing out over here. Practically, the entire market says no February rate cut from the Reserve Bank. There are hopes of only a CRR cut. And if you looked at the OIS rates, the India bond and rupee derivative rates, the overnight index swaps, they indicate no rate cut from the Reserve Bank probably till June. So clearly, yields will only spike.
All right, Lata, thanks a lot for that. Well, from rupee, we now head to the crude oil space. Crude oil prices has surged to a 3-month high. This after the Treasury Department imposed sanctions on Russian companies. Manisha joins us to help us, to fill us in with the latest on the crude oil spike. Over to you, Manisha.
Well, energy has been the best performing sector when you look at 2025 in sense of commodities. If you look at the crude oil prices, we are trading at a 5-month highs, 2% of gains today in the Asian markets itself and 6% of gains in the previous week. So when you look at this year, the crude oil prices have gained up between 10 to 11% for both these varieties. But the latest trigger clearly comes in from the US Treasury Department, which has put very strong sanctions on the oil and gas sector in Russia. The US has put in sanctions on oil producing companies to 200 entities, whether it has been individuals and companies. And then they also have put sanctions on 183 vessels that is shipping Russian oil. There also are sanctions on Russian insurance companies. So everywhere that you look, it does seem like that it is getting closer or curtailed for Russia. There have been reports that UK perhaps could be joining in US for doing that. It does seem like a near-term momentum. The markets do believe that once Trump takes over on 20th of January, it wouldn't want these kind of sanctions to come in. And then again, it is going to be about higher crude oil prices at around $80, $82 a barrel for the US consumers and for the rest of the world as well, which doesn't augur well. So for the near term, well, yes, it does look like it's going to be higher prices because this is colder weather. It also is about OPEC producing less and Saudi Arabia increasing production for the Asian consumers. So various plus factors, and it could go higher from here, but not for too long is what the market really believes at this point in time in sense of crude.
Okay, it's definitely compounded the problems for India. Manisha, thanks very much for getting us the context over there. 5% surge in a matter of, just 1 day, because when we closed on Friday, this was not the picture. We've come back to a very, very different manic Monday. Let's now move on to some individual stock level action as well. And there's more down than up even here. Let's start with looking at Avenue Supermarts. Now, the shares were down almost 5% on the back of what looked like a weak third quarter print. There were a lot of brokerage cuts that came in on the stock as well. Manglam is here with the details. Manglam.
Well, if you look at DMart's performance in the third quarter, there was one positive and a couple of negatives. The positive, however, was priced in because the positive came in the form of an 18% revenue growth, which the street had already reacted to with a 10% uptick on the stock as the company reported its third quarter operational update a week ago itself. That brings us to the exposure to the negatives, and the biggest negative was that of margin compression, a near 60 basis points compression in their EBITDA margins, led by an equal amount of compression in gross margins by 20 basis points, an impact of 20 basis points on employee expenses and other operating expenses, because the company did cite the increased intensity in FMCG competition and or rather FMCG discounting, along with increased operating leverage on store expansion and general merchandise and apparel being just about 23% of their revenue, so no material change in contribution coming in from that high margin product as well. The second negative was a surprise where there was a management change, where Neville Narona has decided to step aside from the position of CEO and MD at DMart after being there at the helm for over 2 decades, and as a result of which the leadership transition uncertainty caused further pressure on the stock. The company's gone ahead and appointed Anshul Asawa as the CEO designate, who's currently the country head of Unilever Thailand, has been with Unilever for over 30 years. So the positive already priced in, 2 negatives with a weak market led to DMart losing 5% today.
Thanks a lot for that, Mangalam. Well, we had 2 more earnings reactions that were weak, PCBL and Just Dial. Upasana joins us to fill us in with further details. Upasana?
Well, both these stocks saw a very steep fall after their Q3 results. First up, let me start with PCBL. Well, the company reported a Q3 which was much softer than the street estimates, mainly due to lower volumes seen in the company's key segment, that is carbon black, and Aqua Farm's tepid performance. Now, revenue saw an uptick of 21% on a one-year basis, while the margins were under pressure almost by 90 basis points, stood at around 16%. And PAT saw a degrowth of as high as 37% on a one-year basis. Now, ICICI Securities says that the carbon black volumes rose 5.4% on a one-year basis, but there was a sequential dip of 3.5%. leading to a pressure. Now, carbon black's underlying business remains intact is what the brokerage feels, and it should improve as volumes will start to recover as FY26 onwards. Next up is Just Dial. Well, the revenue growth slowed for this marginally, but margins inched up on a Q-on-Q basis. Now, revenue grew about 1% on a quarter-on-quarter basis. Margins improved by nearly 2 basis points, that is at 30% versus 28.8% sequentially. And Ambit says that the lack of investment in sales force and marketing has started to impact collections growth of the company. Now, persistent less than 10% billing growth as the company targets margin maximization is the key sell catalyst for the brokerage. Hence, both these stocks remain in focus today on the back of its weak earnings.
All right, Upasana, thank you very much for that. So those were some of the weak links on the earnings calendar as well. Let's quickly go back to our guests. Anand, Tandon and Thakkar are with us. Anand, among some of the stocks that we discussed, I mean, market we've discussed already, but the stocks, Avenue Supermarts or Just Dial, or any of the other majors where numbers have come out, what are your thoughts if you track these companies specifically? For instance, on DMart, I mean, do you share the street's pessimism?
Well, it had a valuation which had run up a long time back, and now for the last couple of years, perhaps it has not done much. And that is logical because, you cannot have the kind of growth that you were looking at. I mean, think about it like this. You cannot both be bullish on quick commerce as well as on, on distributors like Avenue Supermarts, which are based in one geography and have no great presence on the online space. So if you're arguing that you will get, 600 dark stores and be able to deliver most products to the household within 10 minutes, why would anybody go to an Avenue Supermart, DMart and buy stuff unless it's dramatically cheaper, which it is not. And even if it is, then the margins will be under a squeeze. So I think, it's not very logical right now to be betting on this kind of thing.
Okay, all right. Sounding a little bit conservative. Thanks a lot for that, Anand. Well, we'll thank both of you gentlemen, Jay as well as Anand, for joining in and helping us out with analysis on the markets as well as individual stocks. For the time being, we'll slip into a short break. We'll get you all the top corporate voices on the other side with the key market events you need to track for tomorrow. Welcome back. You're tuned into Markets Forward, where it's that time of the show where we get you all the latest on D-Street chatter. Nimesh joins us to help us out with exactly that. Nimesh, take it away.
Hi, Nigel. It was a carnage in the broader markets, right? The mid-cap index down another 4%, and a lot of individual names ended 8, 10, 11, and 20% lower. So that was a kind of pain in the broader market names. But in terms of individual stocks, the first stock is Axis Bank. Within the financials, this stock relatively outperformed all the banking peers, largely on two reasons. One, there was buying interest from larger FIs. And two, there was a Morgan Stanley note in the morning, and they put out a tactical buy as well. So that's the reason why it relatively outperformed. The second stock is CAMS. For second day running, that stock saw a lot of pressure from larger FIs, and hence that stock ended lower. So expect high delivery volumes on the sell side there. The third name is Minda Corp. While the broader markets were seeing so much of pain, Minda has been relatively outperforming, and it's been a very narrow range of late. And the street is anticipating a corporate dividend. Largely, inorganic move is what I understand as far as Minda Corp is concerned. And the last is Marathon Next Gen. Again, mid-cap name, but haven't fallen so much with the overall market fall. And again, for Marathon, the buzz is that the company is likely to raise funds via QIP very soon.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's take a look at all the key management that joined us during the course of the day. Ada's asset quality deteriorated in the past quarter, the management clarifying, saying the blip was a one-off due to one quarter worth around 430 crore rupees slipping in the past quarter. They now expect NPAs to come down going forward. They also guided for the net interest margins to remain in the band of around 3% to around 3.5%. They further went on to add that they'll be looking to raise funds by the QIP route in the fourth quarter of this fiscal.
Now let's move on to the new kid on D Street. Standard glass lining technology made a strong debut on the street with gains of over 20% on what was a really difficult day for anyone to list. The management guides for FY25 revenue to be at 650 crore rupees and expects to be cash flow positive in the next 6 months. Also, the company expects margins to improve, driven by increased contribution from exports. All right, so a heavy day and a difficult day for the bulls. Before we sign out, let's talk about some of the key events that you need to watch out. Tomorrow, Manglam is joining in with the details. Manglam.
Well, let's start with a couple of stocks that will be reacting to earnings post-market today. So we'll have, Delta Corp and HCL Tech, which will be reacting to the earnings that came in post-market today. The others that are reporting tomorrow, in that some of the important ones include the likes of Shoppers Stop, HDFC, AMC, and Network 18 itself. And then from the macro standpoint, we'll watch out for a couple of data points coming in. The India WPI and more importantly, the US PPI will keep all eyes on the Wall Street post-markets tomorrow. And we'll also keep an eye out on a couple of listings. We had good listings today. Quadrant Future Tech and Capital Infra Trust Invit are the two new listings tomorrow. So those are a whole host of events that we need to watch.
Okay. All right, Manglam, thank you very much for that. And with that, it's a wrap on this edition of Markets Forward. Thank you for watching. We'll come back with more news and updates in just a bit.